Number 7, a decline in the fair value of an available for sale security below its amortized cost basis that is deemed to be other than temporary. What does that tell you? Impairment. When it's other than temporary, they're telling you this is an impairment loss. And they say, hey, should it be accumulated in a valuation allowance? No. Be treated as a realized loss and included in the determination of net income for the period? Yes. The answer is B. B. Turn the page. Number 8. The following information pertains to Lark Corporation's available for sale securities. We have cost and fair value at the end of year 2 and at the end of year 3. Differences between cost and fair value are considered to be temporary. The decline in fair value was properly accounted for at December 31, year 2. Ignoring tax effects, what amount should other comprehensive income be credited at December 31 of year 3? Well, since these are available for sale securities, the fair value adjustment is reported in OCI, and the fair value went from $90,000 at the end of year 2 to $120,000 at the end of year 3. So that's a $30,000 increase, so the answer is D, as in dolphin. Number 9, for available for sale securities included in non-current assets, which of the following amounts should be included in the period's net income? Now remember, available for sale securities, the fair value adjustment goes to where? OCI. What's the only thing that gets recognized in income? Realized gains and losses. So Roman 1 says unrealized holding losses during the period? No. 2, realized gains during the period? Yes. 3, changes in the fair value during the period? No. So the answer is number 2 only, so the answer is B. B. Number 10. On December 31, Ott Company had investments in trading securities as follows. We have a cost totaling $30,000, fair value of $28,000. Ott's December 31 balance sheet should report these trading securities as $28,000. The answer is B. I mean, this is taking candy from a baby. Why are we doing this?
Why? I don't get it either. Why are we doing this? Why are you working problems?
Well, because I can look at 30 and 28, and I know you report them at 28. There's nothing to work.
The people at home.
Well, there's nothing to work. There's no reason to pick up a pen. I can tell the difference between 30 and 28, and I know which one to report it at. So there's nothing to do. Now, the next one, there might be something to do. Look at number 11. Zinc Company's adjusted trial balance at December 31, year 1 included the following account balances. Looks like a lot of stuff there, so skip down to the question. What amount should Zinc report as total equity in its December 31, year 1 balance sheet? So we're going to go through this list of things, and we're either going to put a check mark by it to include it, or we're going to put a line through it to exclude it. And we may put a plus sign or a minus sign depending on whether we have to add or subtract. Okay, common stock $3 par 600,000. Is that included in stockholders' equity? Yes. So put a check mark by it, and it's a plus, right? Okay, additional paid in capital 800,000. Is that included? Yes, and it's a plus. Treasury stock at cost. Is that included? Yes, but subtract. So put a minus sign in front of that. Next, accumulated other comprehensive income, net unrealized loss on available for sale securities. Okay, is that part of OCI? Yes. And it's an unrealized loss, so that means it's a negative number. So that's included, and it's a negative number. Then we have retained earnings appropriated for uninsured earthquake losses, and we have retained earnings unappropriated. Well, it doesn't matter whether they're appropriated or not appropriated, they're still retained earnings and they're still included in equity. So include both of those in equity. So if we go back to the beginning now and take 600,000 and add 800,000, that gives us $1,400,000. Then subtract 50,000, that gives us $1,350,000. Then subtract 20,000, that gives us $1,330,000. Add 150, that gives us $1,480,000, and then add 200, that gives us $1,680,000. So the answer is obviously A. Question. Okay, we're supposed to skip questions 12 and 13 and look at number 14 now. This is a good question. The following information was extracted from Gill Company's December 31 balance sheet. In non-current assets, we had available for sale securities carried at fair value of $96,450. In equity, we have accumulated other comprehensive income, unrealized gains and losses on available for sale securities, but it's a negative figure. So what does that mean? Is that an unrealized gain or an unrealized loss? Loss. So what is the historical cost of the available for sale securities? What are we going to do between $96,450 and $19,800? Add them or subtract them?
You would add them.
We're going to add them, but we're going to add the $19,800 to the $96,450. And so the answer will be what? $116,250. The answer is D, as in dolphin. Question. That make sense? Okay, we're supposed to skip 15. Now we go to 16. Data regarding Ball Corporation's available for sale securities. We have cost in the first column and we have fair value in the next column, and we're given this information for December 31 year 1 and December 31 year 2. Differences between cost and fair values are considered temporary. The decline in fair value was properly accounted for in December 31 year 1. Ball's year 2 statement of changes in equity would report an increase of, okay, look at year 1. The available for sale securities had a fair value of $130. At the end of year 2, those same available for sale securities had a fair value of $160. So what should you report in OCI? An increase of 30. So the answer is A. A. Okay, we're supposed to skip 17, 18. Turn over and look at, on page 206, item number 1. Election of the fair value option. Now you've got to distinguish between the fair value option and the fair value method. You need to be able to distinguish between those. The fair value option is when we elect to account for something at fair value, even if the regular accounting treatment that would be appropriate for it would be something else. We have elected to treat it at fair value. When we elect to treat it at fair value, the unrealized gains and losses to get to fair value always go through the income statement. Number 2, you do not have a fair value adjustment account. You make the adjustment directly to the asset account. And number 3, you have to specifically elect fair value for each individual security that you want it to apply to. Okay, so what are the election of fair value? A, permits only for-profit entities to measure items at fair value. B, results in the recognition of unrealized gains and losses in earnings of a business entity. There's your answer. B, flows through the income statement. Number 2, the decision to elect the fair value option is A, irrevocable until the next election date, if any. That's the answer right there. and we're supposed to skip number 3. And on the next page, 207, we skip number 1. Let's go to number 2. X company owns 15% of the voting stock of Y company and 25% of the voting stock of Z company. X has not elected the fair value option. Under what circumstances should X account for each investment using the equity method? Okay, don't even look at the choices. When is it appropriate for us to employ the equity method to account for an investment? When you have significant influence over the investee. That's the only time. So now look at your choices. A, in all cases. B, never. C, never. Or D, only if X has the ability to exercise significant influence over Y, and only if X has the ability to exercise significant influence over Z. So it's obviously D is the answer. All right?
No, I was just saying that you have napkins.
Next question. What is this, number 3? When an investor uses the equity method to account for investments in common stock, the investment account will be increased when the investor recognizes. Okay. So I'm going to call this investment in ABC company, and I'm going to say we own 35% of it. Okay? Remember, we always start with cost/fair value on the date of acquisition. And then there are some adjustments that we make to the investment account. Since this is an asset account, this is the increase side, that is the decrease side. Okay? So, what adds to it? Our percentage of the investee's net income. So the opposite, our percentage of the investee's net loss would be just the opposite. And the percentage of cash dividends also decreases the investment account under the equity method. So this question says, when will you increase the investment account? So when will you increase the investment account? To recognize your share of the investee's net income. A, a proportionate interest in the net income of the investee. There's your answer right there. Now, I'm going to leave that on the board because I think we're going to be able to answer additional questions just by knowing that. Now, if you take Accounting 416, which is being offered in May, we will expand this a little bit to include some other things, and that's why several of these questions in this chapter or in this section are excluded, because we don't cover them in 372. We save them to 416. But this, if you know, will get you all the way through 372. All right, look at number 4 at the top of the page. When the equity method is used to account for investments in common stock, which of the following affects the investor's reported investment income? Goodwill amortization related to the purchase? No, we never amortize goodwill, so the answer to that one is no. And cash dividends from the investee, does that affect our income? No, it affects the investment account balance, but it doesn't affect income. So the answer is no, the answer is no, no, the answer is C. Okay, we're supposed to skip item 5. Let's go to 6. The criterion for determining whether an entity may apply the equity method is the ability to exercise significant influence over the investee. An investor who owns 30% of the voting stock of the investee is most likely to exercise significant influence when A, the investor and the investee sign an agreement under which the investor surrenders significant rights. Now, would that be, if you surrender your rights, is that a case in which you are able to exercise significant influence over the investee? No. B, the investor tries and fails to obtain representation on the investee's board of directors. Is that an example of you exerting influence? No. C, opposition by the investee, such as litigation, challenges the investor's exercise of significant influence. Well, that sounds too like you're not able to exercise significant influence. D, the majority ownership of the investee is spread among a large group of shareholders who have objectives with respect to the investee that differ from those of the investor. That would be the example where you have significant influence. Okay, look at number 7. On January 2, Well Company purchased 10% of Ray Inc.'s outstanding common shares for $400,000. Okay, so create you a T account, just like this, but call it investment in, what is it, REA? Yeah, REA, REA. And right under, to get started, put 400,000. 400,000. And, oh, I'm sorry. It does say only 10% though. So let's see, do they tell us to use the equity method? All right, let's keep going. Purchase 10%, which equal the carry amount fair value. Well did not elect the fair value option. Well is the largest single shareholder in REA, and Well's officers are a majority of REA's board of directors. So there's your significant influence. Okay? REA reported income of $500,000 for the year. Well, what would be your 10% share? 50. So you got 400,000 up here and 50,000 here. And then it says, and REA declared and paid dividends of 150,000. What's your share? 15,000. So in its December 31 balance sheet, what amount should Well report as its investment in REA? Well, 450 minus 15 is 435. The answer is B. B. So again, just knowing the minimum amount that's on that T account, we could have gotten 2 of these multiple choice questions right. Okay, number 8. An investor uses the equity method to account for an investment in common stock. After the date of the acquisition, the investment account of the investor is A, not affected by its share of the earnings or losses of the investee. Well, we know that's wrong because we've got both percentage of net income and percentage of net loss do affect. Both of them affect, so A is out. So now we got a 1 in 3 chance of getting it right. B, not affected by its share of the earnings of the investee, but is decreased by its share of the losses of the investee. No, we have both of them up here. So B is out. Now we're down to 1 out of 2. We got a 50-50 chance of getting it right. C, increased by its share of the earnings of the investee, but is not affected by its share of the losses of the investee. No, that's not right, because we have both net income and net loss up there. So now we know the answer is D. Increased by its share of the earnings of the investee and decreased by its share of the losses of the investee. So the answer is clearly D. Question. Okay, look at number 9. Peel Company received a cash dividend from a common stock investment. Should Peel report an increase in the investment account if it uses the fair value method or the equity method of accounting? Okay, they said an increase in the investment account. Okay, look up here. To increase would be on the debit side. Where is your share of the dividends? On the credit side. So that's not an increase, that's a decrease in the account balance. And if it's the fair value method, remember you debit cash and credit dividend revenue. So it doesn't change the investment account in either case. So the answer is no, no. The answer is A. A. Now, are you beginning to get the hang of how to think about these multiple choice questions? I mean, somebody said, oh, the Gleim questions are 100% different from what we do in the book. They're the same thing we do in the book. Okay, we're supposed to skip 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, and 22. So we go all the way to page 214, look at the investment in bonds. Now this has not changed. This is still the same as it was before. Only section 10.1 was different based on the new accounting standards. Number one, when bond interest payments are sent to the owner of the bonds by the debtor, the bonds are called, the answer is C, registered bonds, when they're registered in the name of the holder. C. B, number two, bonds that investors may present for payment prior to maturity are redeemable bonds. B, they can be paid off early. Okay, now look at number three. Excuse me. On January 1, Welling Company purchased 100 of the $1,000 face value, 8% 10-year bonds of Man Inc. The bonds mature January 1 in 10 years and pay interest annually on January 1. Welling purchased the bonds to yield 10%. Okay, they're only paying 8%, but we purchased them to yield 10%. Information on the present value factors is as follows. Okay, so what they're asking you is, I forgot, they said we bought 100 $1,000 bonds, so that's $100,000 bonds. And the stated rate is 10% for 10 years, right? I'm sure they're asking us, how much did Welling pay for the bonds? So what they're asking us is what goes in this box. And remember, the way you determine the selling price or the proceeds from a bond is to calculate the present